It's Sarah from IN Accountancy. In this short video, I'm going to be outlining for you the 5 main things you need to consider whenever you're setting up your own business for the first time. Now, this is something that we're seeing happen an awful lot at the moment, and many people come to us asking the question, what should I do? What should I be? A sole trader or a limited company? And as usual, in this wonderful world of accountancy and business, the answer is, well, it depends. But there are a number of things that you need to take into consideration. So currently, best estimate is that there are 3.4 million sole trade businesses in the UK compared with 1.9 limited companies. So sole traders do seem to be more popular, and there are a number of reasons for this. Setting up as a sole trader really is the simplest thing to do, and that's predominantly because there's no separate legal entity. So all you need to do is register as a sole trader with the HMRC, and you effectively are the business. A limited company, on the other hand, is slightly more complex. So as the owner of a limited company, you need to set the company up at Companies House. There's certain costs associated with that. You need to make sure that you're registered for corporation tax, as well as setting up any pay-as-you-earn scheme or VAT registration that you might require. So with a sole trade business, you are the business, whereas with a limited company, the company is the business, and you and the company are two distinctly separate legal entities. You will be a shareholder and a director of that company, but not the company. And that's important to remember whenever it comes to the next thing to think about, which is money, because actually as a sole trade, and remembering that you are the business as a sole trader, then the money that the business makes is your money. So that money is your money, and you will be taxed on the profit in that business, regardless of whether you actually take that money out of the business to use it yourself or whether you leave it in the business to reinvest and help the business grow. Money in a limited company, on the other hand, is not your money. It's the company's money, and it's the company's money which it can use to pay you a salary or to remunerate you in the form of dividends, but it's not your money. So this can be quite a complex area that it takes people who've previously been in the job quite some time or previously been a sole trader some time to get their head around, especially if it's just you. But we can delve into that one a little bit deeper in another video when we'll talk about director's loan accounts. So we've talked about money, we've talked briefly about tax, but not in full. So with a sole trade business, we said that you're the business, the business's money is your money, and that you get taxed on all of the profits, whether you take them or not. Another thing to bear in mind is, should that business make a loss, perhaps in its first year trading, you can carry that loss back and reclaim some tax against any tax that you've paid through pay-as-you-earn in a previous job, for example. And again, we'll come on and do a real comparison, sole trade versus limited company, in regards to how your income is taxed in a later video. But for now, the sole trade, you're taxing all of the profits, whether you take it out of the company or not. In a limited company, the company is taxed on the profits. So the company gets taxed on all the profit, it makes it 19%. In a sole trade business, you utilise your personal allowance, and then you get taxed at 20% on income, 9% national insurance, and of course your class 1A national insurance as well. Whereas the company only pays 19% corporation tax. Then you need to take money out in the form of dividends or salary. We've talked about money, we've talked about tax, we've talked about complexity vaguely, but yes, setting up a sole trade business is very, very simple. It's a lot less complex, and therefore it also carries lower fees in general than a limited company. Sometimes clients are surprised that we say, really, for a limited company, it's very difficult to do a set of accounts for under £1,000, regardless of how neat and tidy your records are, and regardless of how much or little trade has gone on through that company. And that's really because there are obligations that you have as a company director and obligations that we have as your accountants to file proper accounts at Companies House, at HMRC, to do corporation tax returns, etc. So the compliance is much more involved for a limited company than it is for a sole trader. And therefore, the fees are more. Now there are things coming in the horizon, and I'll talk about this in another of my videos, which you can find on the channel. There is Making Tax Digital for income tax self-assessment, which is coming in April 2023, and that is going to make actually the accounting and the reporting requirements for sole trade businesses and property landlords again a lot more complex. So look out for that video and dive in there to find out a little bit more on that subject. But on the plus side, so I said fees are higher for a limited company, but on the plus side, you have more protection as a limited company. Again, let's come back to that first point, that as a sole trader, the business is you. So that means should anything go wrong, and heaven forbid, let's hope it doesn't, but should anything go wrong, you're personally liable. So you will be personally liable for whatever the outcome might be. Whereas in a limited company, you of course are not the company, therefore the company is liable. Should somebody decide to sue the company, or should the company not be able to continue trading, the company can be liquidated rather than you facing potentially bankruptcy. So there are those things to bear in mind as well. And I suppose finally, on the upside for now, something to think about is the fact that there are definitely more expenses that you can put through a company than you can through your own personal sole trade business. You can make pension contributions from your company to reduce your corporation tax liability, separate the company's wealth from your wealth, and also plan for your future and put away for your future. You can also claim something called trivial benefits. We'll talk about that in another video. You can have a staff party, which is tax deductible and allowable, and there are all sorts of other little bits and pieces that you can claim through the business if you operate as a limited company. So hopefully that has given you a very quick top line review of the differences between a sole trade business and a limited company. So just to recap very quickly, things you need to think about when setting up your company and deciding whether to be a sole trade or a limited company are the legal entity, whether it's you or a limited company, the money, how you'll take the money out of the business, the profitability you expect. And actually that's something I didn't talk about because there's a tipping point. I talked about the fact that limited company fees are more and that you can't just take the money because it's not your money. What we tend to reckon is that once you're making about £40,000 worth of profit per annum, then it is going to be more tax effective for you to operate as a limited company rather than a sole trader, and that will also offset any additional fees that you might have as a limited company. So if you think you're going to make about £40,000 worth of profit, from a tax point of view, you might want to be a limited company. We've talked about tax, we've talked about complexity, we've talked about fees, we've talked about protection, and we've talked about expenses. So that's a broad brush of the things that you need to think about when setting up your business. Please, if you find this useful, please do share and subscribe if you would. There's a subscribe button somewhere down there, I hope. And I'd love to help you learn more about running your business. Bye for now.